I invested in that first bubble of 1968 and managed to make a small fortune and lose it. And after that, I became a completely die-hard value manager.
You will be shocked to know that investor Jeremy Grantham warns that U.S. stocks are costly and likely to fall soon. GMO co-founder and long-term investment strategist warns us all about the stock market. So let's find out what this is all about. Jeremy Grantham believes the excitement around artificial intelligence, AI, is a bubble that will burst, and the U.S. economy is headed for challenging times. While the stock market has performed well recently, Grantham argues that such strong performance with factors like low unemployment and high stock valuations has historically never been sustainable in the long run. If you want to have a long, impressive rally, you want to see profit margins down, unemployment up, and PEs low, said the GMO co-founder and long-term investment strategist. Starting with very high prices is a pretty much guarantee that for the next 10 or 15 years, you will be disappointed. Veteran investor Jeremy Grantham sees red flags in today's market. He compares it to past market meltdowns like the 1929 crash, Japan's 1990s slump, and the dot-com bubble burst. He points to the market's long surge, low unemployment, and high stock prices as reasons for concern, similar to what triggered those past crashes. Jeremy Grantham finds it strange that the U.S. stock market seems particularly bubbly compared to the rest of the world, especially considering he warned about a global asset bubble in 2022, which stocks did fall that year as he predicted. He compares this frenzy to historical bubbles like the gold rush, where people got rich selling shovels to miners, even though the miners themselves might not have needed them. Grantham fears a similar bust could happen with AI, potentially dragging the entire market down. He believes the market is overextended, and when this mini-bubble bursts, it could trigger a broader correction. Jeremy Grantham isn't buying the rosy picture of the U.S. economy. He thinks the strong job market and economic growth can't last forever, especially when compared to the rest of the world. While the U.S. seems to be booming, other countries are stressed about wars, trade tensions, and climate change. Grantham believes the U.S. is out of sync with these global challenges. It's important to note that the U.S. market has proven Grantham wrong before, continuing to climb despite his predictions of crashes. Surprisingly, Jeremy Grantham is raising red flags about the stock market, predicting a potential crash that could wipe out a staggering 60% of its value. If this happened, it would be the worst crash since the Great Depression nearly a century ago. Grantham has a history of successfully predicting market downturns, and he believes today's market is the biggest bubble he's ever seen. Here's why his concerns are worth considering. Grantham uses the Shiller PE ratio tool to gauge whether a market is overvalued. The PE ratio compares a stock's price to its earnings. The Shiller PE ratio takes things a step further by using average earnings over the last 10 years, smoothing out fluctuations caused by good and bad economic periods. This helps get a more realistic picture of a company's typical profitability. The ratio also considers inflation, which can make profits look higher than they truly are. Grantham says the current Shiller PE ratio is historically high, suggesting the market is significantly overvalued. This, he argues, increases the risk of a major correction. Imagine a company making $100 in profit this year, but inflation is 9%. That means everything costs 9% more, including the things the company needs to run its business. So, even though their profit number went up to $109, they're not actually making more money. They just need more money to keep things going at the same level. This is why the Shiller PE ratio is important. It takes a stock market index, like the S&P 500, and divides its price by the average inflation-adjusted earnings of the companies in that index over the past 10 years. This smooths out economic ups and downs to give a clearer picture of a company's typical profitability. The scary part is that the Shiller PE ratio is near its highest point ever, even higher than before the 1929 crash that led to the Great Depression. Back then, the market lost a whopping 90% of its value over 3 years, and it took 25 years for stocks to even recover to pre-crash levels. But there's an additional wrinkle. Grantham argues that even though the Shiller PE ratio is high, the risk of a crash might be underestimated. And if you ask, why? So it's because some people believe companies are actually making more money than ever before. So the high Shiller PE ratio suggests the market is expensive, but the argument that companies are extra profitable could be masking just how expensive it truly is. This combination of factors is what has Grantham so worried about a potential crash. Imagine a company selling $100 worth of widgets. They make a $1.20 profit on that sale, which means their profit margin is 20%. Profit divided by sales. This profit margin tells you how efficiently a company turns sales into profits. Now let's look at the bigger picture. Grantham's chart shows average profit margins for S&P 500 companies over the last 50 years. Since 2000, these margins have been climbing sharply. By 2019, the average S&P 500 company was making almost double the profit it typically did over the previous 50 years. Grantham argues that the current stock market bubble is inflated and ready to burst, and he uses the Shiller PE ratio as evidence. Imagine the S&P 500 is like a price tag on a basket containing all the stocks in those 500 companies. That price tag, the S&P 500, is currently sitting at 5,000. However, the true value of that basket depends on how much money the companies inside it are actually making. To assess this, we look at their average earnings over the last 10 years, adjusted for inflation, to account for rising prices. This average is currently 147. Here's the magic. Dividing the S&P 500, 5,000, by the average earnings, 147, gives us the Shiller PE ratio of 34. A high PE ratio means you're paying more for each dollar of a company's earnings. The problem, according to Grantham, is that these earnings are unusually high right now. He believes companies can't sustain these record profits, and when they eventually come down, the average earnings number in the PE ratio will drop. This would make the current market price, 5,000, look much more expensive relative to the company's true earnings potential. In simpler terms, the bubble inflating the market right now is the expectation of these high profits continuing. And when that expectation pops, the market could see a significant correction. But Grantham thinks the earnings number is too high. He believes companies can't keep making such high profits and will eventually have to come down to more normal levels. For example, let's say he's right, and earnings drop by 25% to 110. That would push the Shiller PE ratio to a whopping 45, the highest ever in U.S. stock market history. He believes the high profit margins and expensive valuations make a crash more likely. In short, Grantham thinks the market is like a big bubble that's been inflated by companies making record profits. Sooner or later, that bubble will burst, just like bubbles always do eventually. Jeremy expects weak profits, a sluggish economy, and a possible recession. That's why he advises investors to avoid U.S. stocks for now. But Grantham isn't all doom and gloom. He sees opportunities in Japan, emerging markets, and even within the U.S., specifically in quality stocks, climate change solutions, and undervalued resources. GMO, Grantham's investment firm, recently launched a new ETF QLTY focusing on high-quality U.S. companies. While Grantham warns of long-term challenges like AI and climate change, he also highlights potential opportunities in tackling these issues. He may be known for being cautious, but he sees a chance for investors to find value outside the traditional U.S. market. Investor Jeremy Grantham paints a concerning picture of the U.S. stock market, predicting a steep decline due to inflated valuations. He points to a historically high Shiller PE ratio, a metric indicating the market is overpriced compared to company earnings. Grantham argues that soaring corporate profits are unsustainable and will eventually normalize, triggering a correction. He worries the current market exuberance resembles past bubbles that burst and cause significant losses. While Grantham's past predictions haven't always been on point, his warnings highlight the importance of careful investing and considering alternative asset classes. We hope you found the information valuable and insightful. If you love the content and want to stay updated on more financial tips and strategies, do like this video and subscribe to our channel.